CPI just hit the market. Can you profit or will you get stopped out? In the next 6 minutes I'll show you a clean, repeatable, step-by-step plan to trade CPI safely, made by Digital Hustle FX. Let's go. I'm Digital Hustle FX. I teach simple, repeatable news trading strategies. If you want calm, consistent trades during big news, hit subscribe and bell. So, what exactly is CPI? The Consumer Price Index is a crucial economic report measuring the monthly price changes for a basket of consumer goods and services. Think of it as the nation's shopping list. This basket is incredibly diverse, including everything from groceries and gasoline to rent and healthcare. It's our most direct measure of inflation, giving a clear snapshot of how the cost of living is changing for the average person. Because of this, it's the headline inflation number that central banks watch like a hawk. Maintaining price stability is their core mandate, and CPI is their main report card. For traders, the CPI release isn't just news, it's a scheduled high-impact event that injects massive volatility into currencies, bonds, and stocks. The real action comes from the surprise when the actual number deviates from forecasts. A hotter-than-expected report signals rising inflation, immediately shifting bets towards higher interest rates. This can cause a nation's currency to surge while stocks fall in seconds. This powerful chain reaction is why mastering the CPI release is essential for traders. CPI is released on a fixed schedule. For the US, it's published monthly by the Bureau of Labor Statistics. Always confirm the exact release time in your economic calendar before trading. If you're trading other currencies, check their country's stats and release times too. Markets price and expectations. If the actual CPI is higher or lower than consensus, we get volatility. That volatility shows up in FX, bonds, and equities, sometimes violent at first, then a directional move as traders reprice interest rate expectations. First, let's build your fortress. Preparation is key when trading CPI. Consult your economic calendar and set an alert for 15 minutes beforehand. You need to know 3 numbers: the previous print, the consensus forecast, and the actual number when it's released. The market reacts to the deviation between the forecast and the actual. A big beat or miss signals volatility. Now the most critical rule, risk management. You must reduce your position size to a fraction of your usual risk. If you normally risk 1%, consider dropping to 0.5%. This is non-negotiable. During the release, a liquidity vacuum causes spreads to widen and slippage to occur. Reducing your size is your shield against this chaos. Next, newsproof your existing portfolio. Look at any open trades on pairs affected by the US dollar. A violent whipsaw during CPI could easily stop you out of a perfectly good trade. It's often smarter to protect your capital. Consider closing the trade, taking partial profits, or moving your stop loss to break even. Lock in your gains and clear the deck so the only risk you're taking is the one you've deliberately planned for the event. With the decks cleared, it's time for pre-flight calculations. In the moments before the release, adrenaline is high. This is not the time for math. You must do it ahead of time. Use a position size calculator to determine the exact lot size for your chosen risk percentage and a hypothetical stop loss. For example, on a $10,000 account risking 0.5%, that's a $50 risk. If you anticipate a 40 pip stop, your calculator gives you the precise lot size. Write it down. This isn't just math, it's emotional discipline that prevents impulsive, oversized bets. Alright, preparation is complete and your risk is defined. Now for execution. How do you enter the market when the charts go wild? We'll break down 2 battle-tested playbooks, one for the aggressive trader and one for the conservative operator. Neither is inherently better. The goal is to find the one that aligns with your trading personality. Let's dive in. Playbook A is the straddle, an aggressive strategy to catch the initial spike. Here's the step-by-step. First, 15 minutes before release, identify the short-term range on a 5-minute chart. Mark the high and low. Second, place 2 pending orders, a buy stop a few pips above that high, and a sell stop a few pips below that low. This brackets the price. Third, and this is crucial, use a one cancels other or OCO order. This automatically cancels the second order when the first is triggered. If you can't, you must be ready to cancel it manually. The biggest risk is the whipsaw, so using a very small position size is mandatory. Playbook B is the wait and confirm, a conservative strategy valuing certainty over speed. The first step is the hardest. Do nothing for the first 1 to 5 minutes. Let the initial chaos settle. Second, wait for the first 1-minute or 5-minute candle to close. A strong candle closing near its high or low indicates direction. Long wicks signal indecision. Third, look for confirmation. This could be the next candle breaking the high or low of that first candle, or a small pullback that holds. This is your signal. By waiting, you filter out noise and reduce fake-outs, increasing your probability of being right. Regardless of your strategy, your trade management must be mechanical. Every entry needs a predefined stop loss, but a professional plan also includes an exit strategy for profits. A powerful technique is scaling out. Set your first take profit at a 1-1 risk-to-reward ratio. When hit, close 50% of your position and immediately move your stop loss on the rest to your entry price. This creates a risk-free trade. The psychological pressure lifts, and you can let the remainder run to a 2, 1 or 3, 1 target. And remember the golden rule: always respect your stop. Never chase the market out of FOMO. A final technical warning: understand your order types and your broker. A standard market order can lead to significant slippage during news. For the wait and confirm strategy, consider using a limit order on a pullback. This guarantees your price or better, but risks the trade not being filled. Also, critically evaluate your broker. Can their servers handle the volume without freezing? How much do spreads widen? A true ECN broker is generally better equipped. Test them on a demo or with tiny size first. Finally, the most important part: post-trade analysis. Whether you win or lose, your work isn't done until you've journaled the trade. This is what separates amateurs from professionals. If stopped out, become a detective. Ask, what was the data deviation? Did the market react logically? Did I follow my plan perfectly? What was my emotional state? Be brutally honest. Over time, your journal becomes your personal trading Bible. The data will reveal your edge, telling you which strategy works best for you. This disciplined record-keeping is how you turn experience into expertise. Let's walk through a mock trade. Imagine consensus CPI is 0.3%, but the actual number prints at a shocking 0.6%. This is a major inflation surprise. The market instantly anticipates a more hawkish Federal Reserve, leading to expectations of higher interest rates. The immediate reaction is a powerful spike in the US dollar as traders price in this new reality. To capitalize, you could short EUR/USD, a direct play on USD strength. Using a wait and confirm approach, you enter after the initial downward spike. Smart trade management is key. Set a stop loss, say 50 pips. Once price moves 50 pips in your favor, secure partial profits by closing half your position. Then move your stop loss to your entry point. You now have a risk-free trade, letting your winner run. Here's a pro tip: always check the bond market, especially US Treasury yields. Bond traders react incredibly fast to inflation data. A spike in yields often leads the move in the FX market, signaling stronger conviction in future rate hikes. Seeing yields and the dollar move together is a powerful confirmation for your trade. News trading is high risk. Never risk money you can't lose. If you like this step-by-step CPI guide, subscribe to Digital Hustle FX for more clear, repeatable trading playbooks. Smash that subscribe, hit the bell, and drop a comment. Do you prefer straddle or wait and confirm?